Hello everyone, welcome and thanks for watching the Market Report. I'm your host Marcel Pechman, analyst and writer at Cointelegraph. This show debates the most pressing topics impacting the crypto market, focused on price change and meaningful events. In today's The Market Report, we'll be discussing what Bitcoin's latest correction to $26,000 reveals in terms of market conditions. Plus, we'll analyze BRICS' attempt to create a gold-backed currency. Today's show first article was written by myself. Bitcoin price holds $26,000 as derivatives data hints at the end of volatility spike. Bitcoin futures and options data show pro-traders' sentiment was not impacted despite last week's 11.4% correction. Let's start by the conclusion because I think it's important to understand what the end goal of the analysis is. Ultimately, both Bitcoin options and futures metrics reveal no signs of professional trading adopting a bearish stance. While this doesn't necessarily guarantee a swift return of Bitcoin to the $29,000 support, it does reduce the likelihood of an extended price correction. So you've got the outcome. It's neutral to bullish. Now let's see the evidence that points to such direction. Let's start by the Kaiko chart comparing liquidity and volatility. So there's the post from Kaiko data, Bitcoin market depth and volatility. Well, for those unfamiliar, liquidity means the order book depth. So the quantity of bids and offers, so people buying and selling an asset at any given moment. So higher liquidity means more bids and asks on the order book, which is good. On the other hand, volatility is a measure of how strong the recent price moves were, regardless of those being positive or negative. So a high volatility means the price action is pretty strong. The prices are moving strongly, either up or down, it doesn't matter. And low volatility means the price has been rather calm, with no strong moves over the past 30 or 60 days. So the orange area means the liquidity, so the order book depth. And you can see that ahead of the FTX collapse in November 2022, the order book depth of Bitcoin was at 300,000, 2% up or down. So bids and offers 2% distant from the latest price. So that's a whopping $625 million of liquidity, given that Bitcoin was trading at $19,500. But that was ahead of the FTX collapse, as you can see in the chart. The liquidity metric deteriorated over the past 12 months and currently stands near 140,000 Bitcoins, which at $26,000 means there's a hefty $306 million of liquidity. So yeah, in Bitcoin terms, there's a 56% decline. The number of Bitcoins on bid and asks 2% off the latest price, but it doesn't sound horrific. It's still $360 million worth of liquidity. But Kaiko also noticed that the volatility, yes, this blue line area here, has also dropped in the period from 80% in October down to 30% in August 2023. So that means that on average, the price oscillations are not as strong as before. So the blue line is the volatility and the orange area is the liquidity, the order book depth. Consequently, such data presents no signs of extreme liquidity or unexpected volatility post the FTX event. In fact, quite the opposite. Now the question is whether the 11.4% decline in mid-August deteriorated the market conditions, given that it caused the largest liquidations on futures contracts since November 2022. So the first metric one should monitor is the Bitcoin futures premium. The quarterly contracts in any asset, crypto or not, should trade at a 5 to 10% higher compared to the spot markets in annualized terms to compensate for the lockup, as the contracts expire in 1 month, 2 months, so they trade at a higher level than regular spot markets at Bitstamp, Coinbase, and Gemini. So ahead of the crash on August 15, 16, 17, The Bitcoin futures premium was trading at average 7%, which is healthy, inside the neutral area between 5 and 10%. The crash, yes, it caused an immediate dump on the futures premium, down to 2%, but the market quickly adjusted and reestablished the 6% level. So inside the threshold of a neutral market. So that indicates moderate demand for leveraged longs and a healthy market. Such data is confirmed by the Bitcoin options market and other derivatives. The skill metric shows a balanced demand between call, the buy options, and put, the sell options. The metric stood within the 7% neutral threshold, typical of healthy markets. So you can see that ahead of the crash, the indicator was between 0 and minus 5%. Okay, so even down at minus 10%, indicating some moderate bullishness. But even after the crash, the skill indicator remained at 5-6%, so within the neutral 7% range, indicating a healthy market. So no aggressive shock was seen on Bitcoin futures options markets. That reinforces the findings of Kaiko data, which found solid market structure and no evidence of stress despite the 11% drop in mid-August. So the markets are fine, don't worry about that. There's a good chance that we're going to recover the $29,000 soon. How soon? Impossible to predict. Now, moving on to the show's next topic, an article written by Brian Lindrea. Gold-backed BRICS currency will be very hard to deliver, Lynn Alden. Macroeconomist Lynn Alden has cast doubt on a proposal that would see 5 countries work together to develop a common BRICS, Brazil, Russia, India, China, and South Africa currency, arguing it will likely struggle to get off the ground and fail to dethrone the United States dollar. Backing a fractional reserve banking system with gold only works temporarily because the currency units multiply more quickly than the gold does. Instead, Alden sees a more likely outcome would be that BRICS nations lessen its reliance on the US dollar for cross-border payments by increasingly using their own currencies for trade, particularly the Chinese yuan. So let's forget about the crazy idea of a BRICS gold-backed currency. It won't fly, and focus on what could happen to Bitcoin if countries continue to use other currencies, such as the Chinese yuan, Russian rubles, and euros, for example, for oil trading and debt issuing. Once countries and companies no longer need to accumulate US dollars for regular payments, odds are the reserve levels in United States dollars and treasuries will also decline. Lynn Alden perfectly describes what happened under this scenario. This attempt at dedollarization is likely to contribute to structurally less foreign demand for US treasuries, higher treasury yields, and the requirement for the US Federal Reserve to eventually finance a larger share of the US government deficits as a result. So, bad news for USA. However, Lynn provides a counterintuitive advice. If the US Treasury yields increase due to a mass dedollarization event or not, this could cause Bitcoin's price to fall. So headwinds for Bitcoin, as risk assets tend to underperform under these conditions. So that's not positive news for Bitcoin, at least in the short to mid-term. Now, I agree 100% with Lynn on this point. De-dollarization seems the perfect scenario for Bitcoin, but not in the initial weeks or months, when everyone becomes poorer. Even if the numbers in their bank account are growing, given that hyperinflation is picking up, people will panic and sell whatever is considered risky in their view. However, as explained by Lynn, when the US Treasury is forced to salvage the banking sector or issue another round of $1 trillion stimulus packages, Bitcoin scarcity and fixed monetary policy will prevail, providing an excellent opportunity for a bull run towards $200,000 and higher. Just to highlight, that's my own personal view. It does not reflect Cointelegraph's official view, or constitute investment advice. Well, that's it for today. I hope you guys enjoyed the show. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!